Hey, everybody. we are live, and we're actually a couple minutes late. Sorry about that. My internet went from 300 megabits per second down to less than 1, so we had to adapt and overcome. But you guys are in for a treat today because, yeah, we did have the new CFR, and I wore my OKL no because there's some stuff in there that I don't know that we're all that thrilled about. Oh my gosh, hold on. There we go. My computer's rebooting too. But we have some new cool visuals and backgrounds for both Jack and for Adam. So you guys are in for a treat on that, if nothing else. And we'll kind of wade through this most recent 13 CFR Part 120. And so I think I'll pass it to Adam real quick so people can see where he's at. And then let's pass over to Jack, because I know you've done a deep dive on this in the last 24 hours as well. So Adam, you want to show everybody where you're at right now?
Yeah, so I just had to make the Kessel Spice run in 12 parsecs. So I shaved some distance down on that, since we all know that parsec is a unit of distance, not time. Anywho, just kidding. I finally learned how to change my Zoom background. So I have always wanted to pilot the Millennium Falcon, so now I am. There is one that actually has Chewy that I think I should get. So Chewy would be on my side here, so it is hard to get the camera angle a little bit right. But anywho, with these new directions, you know, I don't know. Some of it I don't think was too unexpected. You know, on the positive side, probably, you know, carving out 5% owners of companies is probably favorable from the owner compensation calculations. You know, if you're a large multi-owner organization, you know, that's probably a plus that we figured had a chance of probably coming. And I think in some early guidance, if you went back and fact check this, you know, we probably said that it would behave. I know that we said that it probably would end up behaving that way. I think on the downside is the stuff that they have about capping rents on owner-occupied real estate. You know, on the one hand, you can understand the intent behind it. On the other hand, you know, how does that put the owner of owner-occupied real estate on the same playing field as a commercial landlord who's got the same profit motive that, you know, his rent is fully paid for, just that versus that commercial landlord's cost. So, you know, some positives and negatives on this one. So what do you think, Jack?
Sorry, had to unmute. Yes, I was going to say, you know, not much to talk about because it's so crystal clear on every topic, you know, and as per typical government, you know, they nailed it and got it right. Obviously, that is full of sarcasm and the exact opposite, I think, of what happened with respect to covering all bases. Yes, I mean, the intentions and what they put forth is, we can see the logic behind it, but it opens up so many more questions for interpretation. And so, you know, it may be, I think we assume that most people on this call have read through it, or at least looked through it, not necessarily understood it all. So maybe what we do is we take a few minutes and give you kind of the Cliff Notes version of what is in there. So that way we're all kind of on the same, starting at the same level in the discussion. I will say, as we have in the past, when we get something new and hot off of the SBA or Treasury, IRS presses, because there is a lot of interpretation that needs to go on, that there's a lot of speculation, or, you know, I don't know how that's going to happen. So let me go through a couple of the points to make sure, and Adam had mentioned some of those, which is first that it states that the owner employees with less than a 5% stake in a C or S corporation are exempt from PPP owner employee compensation rule, with respect to, what can be forgiven. The challenge with that, and I guess I'll provide some commentary in between, is that, so what exactly does ownership stake mean? It means the obvious, which is you have a direct ownership stake. But what happens when you have corporate companies that are stacked upon each other, holding companies, et cetera? And when you do the math, derivatively, do you have a 5% ownership stake? So there's going to be a lot of questions and interpretations about that. And as you will know, what is omitted is ownership interests in LLC or partnerships, meaning it's still in there. It's not part of the exclusion. So there will be questions about that as well. We talked about payroll and that the amount of loan forgiveness may not, okay, before I say all of this, it's kind of like there's a distinction between related parties and non-related parties. So keep that in the back of your mind as I go through this. So the loan forgiveness requested for non-payroll costs may include any amount attributable to the business operation of a tenant or subtenant. I'm sorry, may not include any amount that's attributable to those. A subtenant or a tenant. So basically they're saying is that it has to be directly related to your operations. Secondly, rent or lease payments to a related party are eligible for loan forgiveness, provided that, okay, so rent, lease, related part to a related party, the amount of forgiveness is no more than the amount of the mortgage interest owed on the property during the covered period. So there is a relation back that the rent or the lease payments, you as a tenant cannot exceed the mortgage payments that the owner is, the mortgage interest payments that the owner is, mortgage interest that is being paid. Okay, and then that the lease and mortgage were entered prior to February 15th of 2020. So they're trying to avoid the makeshift leases that all of a sudden you put in place in order to try to validate these payments. Okay. Now, mortgage interest payments to a related party are not eligible for forgiveness. Now, you have to kind of map this out in your mind. So rent and lease payments cannot exceed the mortgage interest owed. But if you are basically, let's say you have a situation where the owner says, just cover my mortgage interest, is not directly coverable. So they're using it as a benchmark, but it can't be classified as mortgage interest. It has to be rent or lease payments. Let's see. I mean, those are really the main focuses on what is in there. Yeah, I mean, there's other nuances in relation to that, but I mean, that's the gist of it. And, so then it goes into question that, the certain calculations of payments with respect to caps and other things, but I'll stop there. I don't want to go too deep into it because really, I don't want to spend your time here just kind of reiterating things that you can go and read. There are examples in the IFR, the interim final rule, that say, okay, what happens if, and I'll give you an example of the example. So borrower rents an office building for $10,000 per month. Oh, and I'm sorry, I should say there are also ratios that need to be accounted for as to what is forgiven. So here's an example of that. Borrower rents office building for $10,000 per month. Subleases out a portion of the space for $2,500. Only the $7,500 per month is eligible for loan forgiveness. I mean, that kind of makes sense in the sense that if you're subleasing, it's probably to a separate entity or individual who has themselves sought loan forgiveness. And then they talk about utility payments and other things like that. We talked about the mortgage interest portion of it. And I think there was one more example that I thought was interesting. Okay. Again, back to shared space. Borrower shares rented space with another business. When determining the amount that is eligible for loan forgiveness, the borrower must prorate rent and utility payments in the same manner as on the borrower's 2019 tax filings, or if a new business, the borrower's expected 2020 tax filings. The reason that was of interest to me is had a client who was sharing some space and was kind of being subsidized in the utility payments. That tenant is no longer there. The subtenant is no longer, I don't want to call them a subtenant, co-tenant. And so their 2020 expense is higher because now it's all on them. But you have to go back and look at the 2019 filings to show what was the actual expense. So there's this kind of an implied cap on things as well. So I would suggest that you go through the joyful reading of government language and to see what exactly they put out and see the examples. And as I said in the beginning, lots of questions still to be determined, because once you start going down interpreting, you're like, well, wait a minute, what about this? What about this? What about this? And so the what ifs in the implementation will need to be answered at some point through, I think, further examples and further publications by the SBA, by Treasury, and perhaps, maybe they kick it all the way back up to the legislature, which, as a side note, I haven't heard any real substantive activity on the front, the general front of PPP or of the forgiveness or of the next generation of stimulus package, other than there's fighting going on in the background, but apparently not rising to the level of being reportable, since many people are a little bit distracted with the DNC and the RNC and their own potential elections for their own positions in a couple weeks. So that's about a summary of it.
Yeah, I think, from my perspective, independent of the fairness issue associated with owner-occupied real estate, it's really not that big of a deal for a lot of our clients, because, most of the people that would have been in this situation to receive, PPP funding are going to have payroll expenses anyway. So, I still see our client base utilizing the money. It just means that, potentially, after you back out the inherent profit, which we didn't have people that were getting super rich off owner occupied real estate, but once you back out the profit built into the rental rate, then it just means that you're just going to maybe go a week or two longer on the payroll side than you otherwise normally would have been. So again, that for everybody on the webinar, this really relates to the 40% of non-payroll related costs that we're talking about here. That all that really just happened here is that it got dialed back a little bit, from where it was originally. But again, in the grand scheme of things, if you think about typical owner occupied real estate, 20, 30,000 square feet, after mortgage, unless you own the building outright, I guess that would be a place where this would be that would stink for anybody that has the building fully pay off. But if there is a mortgage, you might be talking about $30,000 to $50,000 a year, which is still a lot of money, but it just means that, let's take the payroll costs a little bit longer than originally planned. Hopefully is where I would hope that this would land. And again, it is unfair. I agree. I didn't write the rules. I don't think it's fair. I mean, just because I bought the building, fully paid for it, and now I have no mortgage, are you telling me I don't get to deduct something? Whereas had I rented the building, that commercial landlord actually still gets to get paid. That just, that's inherently unfair. But again, I didn't write the rules.
Yep. So everybody that's on the call, thank you for joining us again. Hit us up on the Q&A for questions, and you can harass us or try to send something to the Millennial Falcon in chat. So, but we do have a question here from David. Hope you like the t-shirt. This says, when applying for forgiveness, do you have to submit expenses for a specific number of weeks, 8 or 24, or can you apply based on 12 weeks?
So good question. We actually had a client that went ahead and submitted, I think it was to Aquesta Bank, and used their own prorated calculation. So I think our take in previous webinars is there's no guidance on how to perform a prorated calculation if you're either 8 or 24. But this bank accepted a prorated calculation over a 12-week period. So, you know, I think it's possible, but it ultimately comes back to whatever your bank will accept. Personally, I wouldn't. I mean, I would just wait. There's no metal for going for the forgiveness now. I would just wait until there's a little bit more guidance that's come out, because, you know, imagine, you know, same person. This is why this is all fraught with potential problems by submitting early, because what if the same borrower had submitted and had owner occupied real estate and had not included the owners in the employee calculation that were less than 5%, you know, your application for forgiveness is wrong. What's the bank supposed to do? There's no guidance. Like, in other words, I don't think in this guidance, Jack, fact check me, but I don't think there's any procedure like in earlier application guidance that said, and oh, by the way, you know, if you submitted before we issued this, then you're still okay using the lack of guidance we had before. I think this is pretty much, you know, hey, this is the rule, period.
Yeah.
With no remedy on how to fix it.
Yeah, exactly. I mean, I think it would create a huge inequitable result of allowing people to having pick and choose something in between those two numbers. And so, you know, what does that mean? The people who did apply, including the client that you just said, you know, is the SBA going to come back and say, yeah, sorry, pick A or B, and you can't pick C? So
that's right.
All right, got a couple more questions in here. This is from Sana. Did I hear right that if you own more than 5% of the LLC, that your salary isn't counted in the calculation?
So let's see if we can be crystal clear on this. Assuming that this is an LLC tax as a partnership, your salary is included in the calculation for forgiveness. However, if you're greater than 5%, it's subject to the owner compensation rules, which effectively mean the bottom line is you can't have given yourself a raise over 2019 is effectively what that comes down to. And then there's also some nuances about retirement payments and health insurance. But the bottom line is, you know, it's not 100 grand, it's 100 grand or what you paid yourself in 2019.
yeah, and I'll read directly from the IFR that says, you know, the administrator consultation with the secretary has now determined that an owner employee in a C or S corporation who has less than a 5% ownership stake will not be subject to the owner employee compensation rule. I think the theory behind that, and what I've read is that, you know, someone who has 5% of or less doesn't really have the ability to control what happens to those funds necessarily is I think the theory behind it. But, you know, so it goes to, you know, de minimis ownership. If they are getting, you know, if they're really an employee and maybe have been given some ownership interest as part of, you know, just having skin in the game, or, you know, being able to say that they're an owner, but they really are not really an owner and exercise the incidence of ownership, then they really shouldn't be tagged as an owner for purposes of this limitation. And they should be treated more like an employee, essentially, and not have the owner limitations, is essentially the theory behind that de minimis 5%.
All right, next question is from Mark. I have not been on the call for the last 2 weeks. All right, that question is getting tossed over. I'm kidding. Good to have you back, Mark. Is the head count for the 24-week period the same way as the 8-week period in regards to forgiveness?
Yeah, you know, we need to figure out how Jack and I can both sit in the Millennium Falcon. That'll be our test before next week. So
we need to ask some teenagers how to do that, because they will know.
Yeah, and there needs to be some seats behind us so that Gary can be, you know, in the loop position.
Yeah.
Anyway, yeah. So the average FTE count is the average FTE count, and it doesn't matter whether you're 8 weeks or 24 weeks. So you know, I think with the 24-week though, the reason for the 24-week time period is they're assuming that you'll have an exception. That is why they gave us 24 weeks, because you couldn't deploy the money. Well, what's the only reason you couldn't deploy the money? It's because you let people go. Well, then by default, you're probably not going to hit the average FT count to say, hey, we're even Steven and everything is totally fine. It means that you're going to have an exception, which would either be rehashing, you know, I laid them off. I tried to get them back. They wouldn't come back. Two, they're claiming some sort of health thing that they can't come back. When I say, I don't mean to say that flippantly, you know, they either have COVID or they're taking care of somebody that has COVID, or there's some other government restriction around it. Or three, you know, I had a downturn that is otherwise I don't need the positions anymore. Or four, I got everybody back at the stroke of midnight at the end of my cover period. So, you know, if you're operating under 20, anything really, you know, beyond 8 weeks, it's highly likely that you're applying for an exception somewhere in there, because that's why you had to use the money over a longer period of time.
All right, next question is in from Kim. I just got an email. You recently received an invitation from the U.S. Department of Health and Human Services, HHS, to apply for payments from the Phase 2 general distribution of the Provider Relief Fund. Any thoughts on applying for more money? Thanks.
I mean, this is really, Jack, you may know more about this. I mean, this is really for companies that are associated with frontline healthcare work to acquire PPE. You know, I don't see a downside. What do you think, Jack?
Yeah, two things. First, you need to be careful of scams in general. I'm not saying this is a scam. I'm just saying as a general comment that I have seen, and I've received questions similar to, hey, I received an email from such and such, and you know there are easy ways you can see if it's legit. So if it's, you know, the DHS, then it'll come from a domain, a DHS domain, and you can take your mouse. You can't do this on the phone, but take your mouse over the link or the email address and see if it's for real. You can also go over a link that says click here and see where it eventually goes to. Now, there's some creative people out there that try to make it look legit. So just be aware of that and be very suspicious, because there's a lot of scams going on as far as saying, hey, apply here and then give us all your personal information or your business information. And then, you know, it's a new way of an old scam, essentially. Having said that, yes, there are loans or grants out there that are for specific industries. So, you know, if you are in that industry, whoever the inquirer is, if you're in that industry, then maybe it's legit, maybe looking into it. But I would suggest that you not go through that link, but you go to DHS's website and wherever the source of these funds are, to see what the program is, to validate it that way, rather than clicking through whatever is emailed to you.
You're muted, Gary.
I got too many screens going on here trying to duct tape and baling wire this thing together. It's the Millennial Falcon where we got hit. Jack,
Easy, baby, hold together.
Exactly. Jack, you had sent something on, there was a North Carolina, let me see what this thing was called, the job retention grant. Did you want to talk at all about that?
Yeah, so generally speaking, I would suggest, and I know that there are some people on this call, and I have some clients that for whatever reason, they haven't received their money yet, or they have received it and it just isn't quite enough. But there's a lot of money out there that has been untapped. And I think it's because people are so focused on what they hear, PPP, 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 that there are little other pockets of money. And I'll tell you that I do work for an organization here in town that is a facilitator of getting money from point A to point B. It's a quasi-governmental agency. And so I helped with some of the application process and things like that. So I know the money's out there, but the one thing that was sent to me is the Foundation for the Carolinas is putting together or administering this, what they're calling this Charlotte City Grant. And basically it is, and it's limited, it's for smaller businesses, but the key element is it's in addition to, you're not disqualified because you applied for or even received PPP funds, but it is you either can get $10,000 or $25,000. You have to have less than 25 employees, and then the cutoff between the 10 and 25 is 6 employees. You have to have business revenue of greater than $30,000, but less than $2 million. The recipients are randomly selected by geography, meaning in the city of Charlotte. It's a city of Charlotte grant. And so, you know, that was their way of trying to ensure not having disparate treatment. So it's, that's why I say it's like, it's a lottery, it's free money. If you fall within the parameters, the buy-in for the lottery ticket is your time, essentially. So it's not even monetary. So why wouldn't you do it? Grants are awarded every 2 weeks. There's a software algorithm that picks people. You don't have to reapply, you know, after every 2 weeks. Once you're in, you're in. You will get a Form 1099 miscellaneous. You have 4 specific uses, allowed for 4 specific uses: business rent and mortgage, 1, business utilities, employee salaries and benefits, and supplies and restocking. But there's no 60-40 or anything else, other limitation as far as I can see. And you know, they talk about the application process. You can't call them. You'll get an email that says you have a password, you're logged into the system, then you have to apply. You'll get an application receipt confirmation, but and then if you get the money, you'll get notified, and then you get the money. And I think they said you will be notified. 2 days after you're notified, you get it. 48 hours, you have 10K or 25K in your bank account. If you don't receive the grant, you will receive notification, but it stays open until mid-October or until the money runs out. And I think the res or the base money, and I can't remember how much it is, but I mean, we're talking millions of dollars that are just sitting there, either in the city's bank account or the foundation's account. So, you know, no reason to not apply for it. If you're a sole proprietor, you can apply. If you received SBA money, you can apply. Here are the geographic limitations. Only businesses headquartered within the city limits. And then there's questions, if my headquarters are not based in Charlotte, but I do most or all of my business in Charlotte, no, there has to be a physical presence within the city of Charlotte. You can't be a resident of Charlotte and have your business elsewhere. So it's not based on your own residency. It's based where your business is physically located. Franchisees are eligible so long as the location is in Charlotte. If you are a multi-unit franchisee, then you can only apply once. So, you know, I would suggest that if this is something that might interest you, to go to the Foundation for the Carolinas website, and they have it's you know, /CLT City Grants. You'll be able to find it. I'm sure it's on the main screen, and take a look, because like I said, it's a lottery ticket. And the payment is your own personal time, which it doesn't seem like. In fact, they say, hey, submit these 3 things. And then there's a question, hey, can I make my chances better if I submit more? This is an instance where you don't have to be an overachiever. Please don't be an overachiever, because just give them the 3 things that they want and be done with it. And hopefully you win the lottery.
That's good. Here's another one that I got from Thomas McTeer that may be of interest. From United Community Bank. And if you guys want a link. I will send you a link. Just send me an email after this webinar to gfrey@trustbgw.com. Again, gfrey@trustbgw.com. But they've got an SBA Express lending program, and basically here's the deal. So it's working capital financing. Maximum loan amount is $1 million. Terms is 10-year maturity, 5-year revolving, and a 5-year term out. The rate is variable. Maximum guarantee percentage is 50%. Collateral is a blanket lien on the ABA, and minimum loan amount is $250,000. So again, you know, it's providing cash with benefit with flexible repayment terms. Analysis can be based on lenders' conventional processes. Lenders can use their own documentation and process for closing, and it's a lower guarantee fee than most other 7A products. So another thing that just came into us recently in the last couple of days from Thomas McTeer, and he's helped a bunch of people get PPP loans. These are clients of ours that got stuck in the queues in the big banks. So, and he's a good dude. Any other questions out there?
While we're waiting for questions, I'll share one thing that I read, and credit to you, Gary, because this is one of the things you sent to me in the past 24 hours, but it's something that makes sense in a sense that, okay, this restriction on payments of to an inter-party lease. And, you know, the commentary was that it makes sense that there is a limitation on the amount of money that can be forgiven, or the amount that can be forgiven when you're paying a related party. The purpose of that in this commentary, and I agree with it, is that to avoid, let's say that you as an operating entity, a business, is paying your own LLC, but you're paying an inflated rental rate. And so how do we provide an objective cap on that? And so they decided that they would use the interest rate, or the interest that's being paid by the owner of the property, rather than having to go through this analysis of what is market value, what is not, which is obviously much more subjective than objective. The problem with that is that what happens when the relationship is better than market, meaning that the operating company is paying the owner, related party, less than market rent? I mean, isn't that a penalty to the payor, to the operating business owner, to that business entity, in that not forgiving that because they are not, you know, exceeding market? So, you know, it seems like it should be the lesser of, or maybe it's the greater of the market or the interest paid, to be fair about that. And so that is just, you know, one of the issues that's going to be, there's a lot of, I'm sure a lot of you on this call have businesses. If you own the real estate, you have it in a separate entity, and there is a friendly but it's arm's length. You have a debit and the credit. You have, you know, business expense. You have business income related to, you know, owning the property. So that is just an example of one of the big holes that is in there in relation to this restriction. But the SBA is coming at it from the position of that, well, I mean, what other variable or what other measurement can we use that isn't going to be, you know, all up in the air, in order to prevent overpaying somebody who is smart enough to do the bifurcation of the businesses, which many people do. It's just, it makes business sense and is asset protection. So there are those kind of issues that come up, and I just wanted to share you guys that as an example of the problem.
All right, next question up is any update on the payroll tax executive order?
I don't have an update on that. It's, you know, okay, again, now we're 3 days. We were 10 days away last time we talked about it. And I have not seen anything about any guidance or anything that you would think logically, if this is going to work, what's going to happen. Like, hey, employers, here's how you implement this program, including letting your employees know that they have this option, but also making sure that they understand if they exercise the option that they're going to have a huge tax bill starting January in 2021. So I've seen none of that come down the pike at all. So I don't know what that means. Does that mean it dies on the vine? Does that mean that employers should do it themselves and hopefully they don't mess it up? And I do have one piece of information that the clients that I talk to that are considering yes or no have said, well, I'm just going to keep rolling the way I always have, which is I'm just going to take this money out unless an employee really is adamant about it. But I'm not going to make it known that it's a possibility if they don't already know it. Some are saying, hey, I'm going to make it known that this is a possibility, have them do their own due diligence, suggest to them it's probably not a good idea because all it's doing is pushing the pain further down the road. But understanding there may be some cases where having that break now is gives you a better chance of being successful and coming through this on the back end. And then at the back end, you will have a better ability to have the burden of the double payment or the increase. So I've seen various logic applied, but there's no standard that I know that I'm aware of, even close to being implemented.
Yeah, I think, the rubber hits the road in that, I don't know the exact date on this, but if you just look at our own client base as a bellwether, I'd say probably 85% of them have their payroll outsourced to a third-party payroll provider. I've seen zero. And if you've got somebody on the phone that's seen someone from there, or in the webinar that's seen somebody from their payroll company, please go ahead and hit up the chat feature. But I've seen zero from a third-party payroll administrator that has talked about how this would happen. Because if you think about it, that's where it will actually occur. Is you would have to notify, Paychex, Paycor, ADP, local guy, ADP, local guy, whoever you're using. You'd have to notify QuickBooks if you're using QuickBooks. You'd have to notify them that, hey, this employee doesn't want you to take the money. Like, who's supposed to actually get the employee the money? If you think about it, is it the payroll company to make sure that it actually went to the employee versus me putting it in my pocket and just saying it went to the employee? Which is the classic case of the payroll trust tax violation. And how do you know, as the person that paid it in, that the payroll company actually got it to the employee at all, or timely? How does the loan get, repaid? Is that something where the payroll company does extra withholding, at some point in the future? These are why they had all these questions around the difficulty in actually implementing this one. So I think that even if you wanted to do something, unless you're doing your own payroll, I just think it's likely mechanically impossible at this time, because when you call up and say, hey, take my money, to process your payroll, you don't really have a choice with a third-party payroll provider on, oh, but not all of it. I want to keep the payroll tax money. Well, that's just, they don't typically get in the business of doing that, because they don't want to be responsible for you having not paid in your payroll taxes for whatever reason. Secondly, this one is even funnier. What if I'm with the PEO? What am I supposed to do then? Because technically I'm not an employee of my own company. I'm with the completely, so if I'm using ADP's PEO, or I'm using Insperity, or I'm using TriNet, how's that supposed to, happen? Since I'm technically getting a W-2 from this PEO. So it's a sticky wicket on this one.
Yeah, and I would say that it's saying it a little differently, but to put it in perspective is that there's not been enough CYA-ing going on as between employer, it's like, hey, we'll do this, but you need to acknowledge that you told us to do it and you understand the consequences. And so whether it's, the payroll company or it's the employer, there needs to be, if one of my clients said, I want to do this, then I would provide some suggestions on how you implement that to cover yourselves so that you are not accused down the road of doing something that you had the ability to understand better the consequences than your employee. So beware of that and the choices you might make without having this guidance that we all on this call think is necessary and sufficient to implement that option with your employees.
And we talked about this a couple weeks ago because I was out last week. Thanks for covering for me last week, guys. But basically that executive order deferred, but it didn't forgive the employee's Social Security tax liabilities. So just keep that in mind. Phil has said, hey, would you or do you plan to post the new guidance on your website? Yeah, we will. It'll take us more than 24 hours to get it on probably. If you want, hit me up on my email and I'll send it to you, or you can Google it and just look up basically 13 CFR Part 120 and you'll find it. Again, 13 CFR Part 120, where, like I said, if it's easier for you, just email me and then I'll send it to you. So hopefully that answers for Phil. Judy says, I've missed out on connecting on your sessions the past few weeks. All right, we're throwing yours out to the side as well. I'm kidding. Has there been any update as to whether the PPP forgiveness funds will be taxed?
No.
You want to handle that?
There's been no update. So same guidance applies. I mean, think a lot before you go for forgiveness, because you're either writing a check April 2021 for it, or you're writing a check April 2022 for it, depending on the year in which the forgiveness is granted, based on what we know today. Now, I think in all likelihood, even if legislatively something doesn't happen, I really see somebody just saying, we're going to take a shot at challenging this in tax court, because it's the IRS interpreting a case law that they won, that really, I mean, like the case law that they're pinning all of this on. We talked about this a lot of webinars ago, but the case law that they're basically pinning this on is that a teacher received a grant to study abroad and then still deducted the value of the trip. That's the case law we're talking about here, not global pandemic situation. And to go back to the inherent unfairness of this, if I got 100 grand, let's use, a big number. Let's say that I got $1 million in PPP funding. If I deploy the full $1 million, I still got to come up 300 grand out of pocket to pay the taxes on it, the way things sit currently. So I don't know what Munchen's talking about. Can I go learn his math about how I still square, and all that? I had to come up 300 grand out of pocket. I get it that if I would have earned $100 million, I would have had to come up 300 grand out of pocket to pay the taxes. But in this case, like, I'm the only recourse that I can use to come out square would be to not deploy the $1 million. Thus I end up in this horrible equation. Which, Jack, can I borrow your kid's math website thing to figure that one out? It represents, how much loan am I going to get left with? Basically, I'll get left with a loan to cover the taxes on the money. It's just dumb.
Which is a reminder, you know, if nothing else, we provide value in indirect ways. So for those of you who are not on that webinar session, it's called Photomath. And again, you just, like I said, you will be forever indebted to us on this call for making your parenting, your teaching at home so much easier. Now, you know, it's up to you to set up rules whether or not your kids can do it on their own. But so if you, as I said before, if you've forgotten what the chart or the graphing of when you take a variable and you square it, it is a parabola. So there you go. Something that you don't need to know, but it's just, you know, Cliff Clavenish.
Photomath. That's good. Awesome. And if we can't figure out
me.
what? Whoa.
Sorry, there you go.
Chewy approves.
Yeah, I'm gonna have to ask my 6-year-old grandson if he can help me get this Millennium Falcon on my computer. Oh my goodness. Any other questions out there before the Millennium Falcon moves into another time warp?
So Adam,
None.
is yours the one with the broken front or the solid front? Like, you know.
You know, I haven't been double checking my continuity. I'm going to be honest. I went to the Star Wars official fan site. But this ain't like Dustin Crops, boy. It requires precise calculations. Otherwise, we end up jumping into a star or a supernova.
Oh my goodness. Well,
Actually, I'm gonna do the Christopher Walken version of the audition. If you guys have ever seen this, it ain't like Dustin Crops, boy. I guess that's John Travolta a little bit more. Anyway,
oh my
I think he tried out too at some point.
Well, for all 42 of you that are still left on this, thank you. Hopefully we provided some value and a little bit of comic relief in the middle of these crazy days. But we will be back on the same bat channel, same bat time next week, 11 o'clock on Thursday, Lord willing. So if you have any other things in the meantime, feel free to reach out to me or our website, our email for our help desk, which is FAQ@trustbgw.com, FAQ@trustbgw.com. And I hope you guys have a wonderful rest of the week and take care. Bye-bye.
Thank you.
See you guys.